Millions of Canadians woke up with a sigh of relief this morning after Tiff and the Bank of Canada held rates steady and avoided a ninth consecutive hike yesterday by leaving the overnight interest rate unchanged. So people are breathing a lot easier. People are going to get a reprieve until April 12th. Although Tiff did indicate that there was going to be a pause, it's really going to be up to what happens with inflation, the Canadian dollar, and some other markers and data points that are due in the next month or so. So Carolyn Rogers, the deputy governor, was speaking today in Winnipeg and indicated that the pause could indeed be conditional if they still have to fight inflation. So folks, we are going to be holding our breath. Although we're getting a little break from the rate hikes, I think it will be short-lived, and we could very well see some further hikes in the very near future. And just to give you an idea, the Canadian dollar is already taking a dive. It's already lost about 1.5 cents in the last 4 or 5 days. It was sitting at just under 74 cents US. It's now down to 72.28 as of about 30 minutes ago. So we're going to keep an eye on this. And remember, if the Canadian dollar drops further, that means we're going to be forced to import stuff at a higher cost, which further fuels inflation. So don't get too excited about the pause. It could be short-lived, and we could technically be seeing an increase possibly in April, maybe in June. We'll see. We'll see how that goes. But, you know, the Fed had their Standing Committee on Agriculture and Agri-Food session today, where Jagmeet Singh was chasing down the CEOs of all the big grocers and trying to let them feel his wrath. But the reality is grocery stores have a very, very small margin. And to put things into perspective, you know, the folks out east that run Sobeys, I think it's called the Empire Group, you know, they're running on 2.5% margin. Loblaws and the Weston family, they're running on about 4% margin. And one of the examples they used was that on every $25 of groceries being purchased, Weston makes $1. Okay? So, folks, what people need to understand is the price of inflation has been driven by input costs. The input costs going into all the food being produced is driving up the cost of food. It's not the grocers. And I think politicians got to be very wary, okay, and very cautious about going after grocers, because if they start opening up their books and realizing how much of an impact increased minimum wage, increased costs, increased taxes, and increased carbon taxes have on the whole supply chain, they're going to realize very quickly it's not profits that grocery store companies are making that's the problem. It's all the input costs and the added costs going into the farmers growing their products, their taxes on their gasoline to fire up their trucks, tractors, and stuff like that, all their fertilizers that are being hugely taxed, transportation, all that is going up. And when that goes up, it's going to be passed on to the end consumer. And it's really sad what's going on, but the reality is I think the feds and these politicians are pointing at the wrong person. The grocery store is not the boogeyman. Yeah, they have their warts, and I'm sure that you could find something involved in what's going on over there. But the reality is farmers are getting hurt, dairy farmers are getting crushed. They're having to throw away down the drain because of quotas. Okay, so if you have a lot more milk than you're selling, it should be cheaper, but there's price floors, and this is a problem. So I think the system is, you're starting to see cracks, you're starting to see things break, and it's becoming quite a challenge. But nonetheless, this break is well deserved. The 8 rate hikes over the last year have started to take its toll. We're getting some unbelievable phone calls, and you know, I want to bring one in particular that came in today, and it was someone looking for help, and he watches our show. He lives out in Woodstock, and he's looking for a solution. And here's his situation: has a first mortgage of 585 at 8% with Home Trust. Has a second private for 70 at 13% plus. Payment is $795 on the second, $4,400 on the first. Total almost $5,200 a month in mortgage payments on about $655,000 in debt. Okay, the property's worth $700 and change at best. He can't get a refinance. Total household income is $91,000. Okay, he's making $7,500 gross. He's paying $5,200 in mortgage payments. Okay, the numbers don't work, folks. And you know, he asked me what we could do, and I said, sell. You're probably better off to sell this thing, try to put a bit of capital in your jeans, and go rent a place for $3,500, and put $1,700 in your pocket to save. And the reality is that doesn't include his car payment. It doesn't include gas because he's commuting to Ancaster from Woodstock. So that's got to cost him a pretty penny just in fuel costs. He's got to eat. And there's not enough money left before the month ends. So they've depleted their savings. This is the type of situation that is starting to creep up more and more as people scrape through all their savings, all their RSPs, and are left with this negative cash flow that they can't keep up with. So, you know, when I suggest that things are going to get uglier in the second and third quarter, it's situations like this that are popping up. People are unable to deal with the increased cost of these renewal interest rates. They're just too high. They're unexpected. As much as people try to adjust their spending, it's becoming very difficult to do. And it's quite an interesting situation because this seems to be the trend on an ongoing basis throughout the day. And you know, we're trying to provide options and solutions, but in this particular case, it just makes no sense to do anything refinance-wise because it's just going down a terrible cycle of worse and worse debt costs. Nikki, today I agree with you. I told someone to do the very same thing. This is starting to be a trend, folks, and anyone who seems to think that we're out of the woods is misleading you. Okay, we are in for some very difficult times. With the U.S. Fed indicating that they're going to be increasing rates, it's going to put more pressure on our dollar. It's going to drive inflation up again, and this Bank of Canada is clearly focused on trying to tame inflation. So expect further rate hikes to come. We have seen some relief on the bond market a little bit after the rate pause. The 5-year Canada bonds down to about 341, 42. That's a good sign, down from 367, so about a quarter point drop since last week. Very, very good. There's a question here. What's the sweet spot if taking a mortgage now? A 2-year or a 3-year? Also, election is coming up in 2 years. Well, I'm leaning towards a 3-year, seeing that the duration of this mess is going to take a lot longer than people think. I don't think the election is going to solve anything. You know, whoever takes over is going to have a big mess on their hands, and that mess is going to take a while to clean up. Like, this is starting to become quite concerning, and you know, there's just not enough cash flow left in households, you know, and you know, the gap between the rich and the poor is widening like crazy, and the middle class is getting wiped out. they're getting hammered, and you know, these renewals. There's 1.1 million renewals happening in 2023. We're starting to see the tough situations come through our office on a daily basis, and it's concerning. It's quite concerning. But you know, we'll see how this all plays out. But I don't suspect we're going to get through this very quickly. I don't know if anybody has any questions. As far as the used Porsche tracker goes, this week saw a big decrease in listings on AutoTrader. So for those of you that aren't aware of what data point I focus on every week, is how many used Porsches are for sale on AutoTrader, and I use a 100 kilometer radius from where I sit at Dufferin and Orphis, just south of Yorkdale, as a guide. And when we started doing this in September of 2022, we were sitting at 944. We went up as high as 1138, I believe, 1136 or 1138 about 3-4 weeks ago. We're down to 1,076 used Porsches for sale. It's down 24 since last week's 1,100 number, and that's still up 14% over September. So the toys are still for sale. We had a bunch of people buying some, or they took them off the market, but really interesting to see how that data point factors into rates, the market, and the climate. We got a question here from Brinny. Why does the potential U.S. rate hike affect our dollar? Okay, I'm not going to get into the technical aspect, but I'm going to try to really generalize here. When there's a difference between what the U.S. prime rate is and the Canadian prime is, there's an opportunity for arbitrage. And what ends up happening is our dollar weakens because it's more advantageous to invest in the U.S. than here. Okay, that's in general terms. Okay, it's not exactly that way. And when there's this disparity, our dollar will drop, which means what we import into our country becomes more expensive, and we basically import inflation. So as Canadians, we import a lot of produce, a lot of fruits and vegetables from down south, okay? And we import a lot of products. If we have to pay more for it, then our inflation is going to go up. And it's simply just math at that point. So hopefully that general explanation helps you out, okay? But thanks for asking. Realtor_Joseph 209 asks, what's the best 1-2 year fixed rate with big 5 banks? They're not very good. They're closing in on 6%. And we'll see where they land this weekend. Usually we get rate sheets on Fridays, and we'll see where they land, but they're not very attractive. The 3 year seems to be the play, although they're trying to tease you with the 5 year, but we'll see where that lands. But if you need more details, whether it's insured, uninsured, alternate, non-conforming, there's a number of different aspects to that question, so I really can't give you a specific rate. So if you want any details, give me a call and I'll give you more insight on that, okay? What's the difference trigger point or trigger rate? I think they're one and the same. If you get triggered, it has to do with hitting a certain rate. So I think it's one and the same. Sue's 519, thank you for the question. Anna Dow 48, what's the 5 year fixed rate right now? Not very attractive. We're looking at 534 to 549 right now on a 5 year. If it's insured, it's going to be a little bit less. It's going to be in the low fives. We're not seeing a lot of insured products these days. Most of the purchases or property values in Toronto are over $1 million, so we're not seeing too much insured at the moment. Rocco OP, thumbs up to you too, thank you. Homes with Hills, encouraged to see the rate holding finally. Yeah, like I think the rates have settled a little bit. They're still in that mid-5 range, which is still reasonable, but the stress test is what's contentious here. When you have to qualify at a rate in the 7s because of the 2% increase to the contract rate, it creates a lot of problems, and affordability becomes an issue. Not many people have the earning potential and the debt servicing requirement to service debt at those rates, and it creates a lot of problems. One thing we are seeing are a number of deals, sales that are conditioned on finance, and people can't get their financing sorted out, so deals are falling apart. So there's this huge eagerness to buy, and we're seeing that activity. We're still seeing multiple offers, and primarily it's due to listings at below market causing that activity. But they're still getting some financing conditions in there, and when that takes place, people have the opportunity to make sure they could get the financing, and in some cases, we're seeing values not come in. Like we had a case up in East Gwillimbury. People bought 5-day condition, they got the financing, but the appraisal came in a little bit light. So they're asking for a second appraisal to see if they could get somebody to come in. So that's causing a bit of a sticking point in the transaction. And there's going to be probably a haircut negotiated to get this deal done, because do you want to go back to market? The person who's buying is going to have the same problem with the appraisal. So if there's not a lot of price discovery in the marketplace where there's comparables to support a value, there's going to be a challenge, especially when there's not enough sales. So, you got to be aware of what the market could support if you're looking for that high leveraged debt to value ratio, right? So if you're looking for that 80% loan to value ratio, you got to have that appraisal to support that financing. And we're seeing some situations where it's not coming in. And I don't know if that is a fear from the appraiser itself, or in some cases just a lack of transactions to get comparables to support values. Very, very interesting time. But I think people just got to be very cautious, be very careful, and be patient. Just be very, very patient. I had a few more people kicking in here. Here's another question from Brazu Kane Tio. Vince, can you comment on hard lofts on this market? Is it a good time to sell into this historically low inventory level? I think the opportunity presents itself for a seller if they have a highly desirable property. As far as the hard lofts, I'm not sure what that means. I'm wondering if that is a condo conversion property. I suspect that's what it is, but if I'm wrong, please correct me. But if you have a highly desirable property and it presents well and it's properly staged and it's really an eye catcher, this could be the perfect market for you in a depressed situation, because there's people that want to buy, there's not a lot of product out there, and if you have the right real estate team that could present that property in a very positive light, it could be bingo for you. So, I think it could be a great opportunity to take advantage of the market as we start seeing a flurry, and I mean a flurry of condos coming onto the market in the very near future. As I mentioned previous on other shows, there's 32,000 condos that are going to be sold in 2023 and closed. They'll be flooded they'll be sold immediately. The majority are investors. They're upside down. They're having trouble getting financing. They're having to carry alternative or private mortgage type rates on their debt. They want to get rid of this stuff. They can't sell it in the assignment market, and you're going to see a flood of this stuff coming on the market in the second and third quarter. So if you have that opportunity, take advantage of it. Rick Benepal says, you were saying to expect more rate hikes to come. I thought the Bank of Canada was holding off on rate hikes for all of 2023. Is this not the case? No, they indicated that they're pausing interest rates. Doesn't mean they're holding off for the rest of the year. And that pause today was excuse me, I have a dog in the house, so I'm dog sitting, so sorry about the barking in the background. But going back to my point, it's a pause. A pause doesn't mean they're stopping, okay? This isn't the terminal rate. And what people need to understand is if inflation continues to hold steady, they will use additional rate increases to combat it. Carolyn Rogers today in Winnipeg indicated that. The pause is conditional. So no, it's not the case. We could see further increases, okay? And I don't mean to be the bearer of bad news, don't shoot the messenger, but it's really important that everybody understands that. There's no party, folks. I'm telling you, this is not going to end well. I'm not sure if anybody else has any questions, but you know, this is an interesting time. I want people to start thinking about budgeting. You know, I stress that a lot. Look at your needs, get rid of your wants, focus on paying down debt, getting rid of debt, understanding what you have in savings, understand how liquid it is. Be aware of what could be coming, and just be responsible. It's so important to keep in mind as to what's coming. Okay, and listen, I hope I'm wrong. I really do. I'm not here to scare people. I just want people to understand that this isn't over yet. Okay, we stopped with the hikes in March, this week. Okay, it's a pause. They could still go up. Rates are still relatively high to what people were paying a year or so ago, and I want people to think about this. Okay, just listen to this little part because I think it's important. 36% of mortgages are still in variables. 45% of all non-mortgage debt is in HELOC balances. And there's 1.1 million mortgages coming up for renewal in 2023. It's only March 9th. All three of those buckets will see the interest cost since last year more than double. In some cases, they will be going up 2.5 times. When your interest cost goes up that much, it's going to have a major impact on your discretionary spending, on your household expenditures, okay? People are going to have to do with less. And when people have to do with less, things start to break. People start, like, you can't do stuff. You're going to be limited. You're going to have to crunch the numbers. You're going to have to probably get a part-time job. Probably going to have to put a tenant in the basement, okay? These are all real issues that will be happening. Now, people have gotten by in the first few months because they've got some credit card limits that they could use. They got room on their lines of credits. They have some savings. They got some RSPs. But once that's done, all bets are off, folks. People are going to struggle. And this is what people have to understand is going to happen, because these rates aren't going back to where they were. Okay, so folks that are maturing this year are going from 2.49% to over 5%. That's a double. People that borrowed money last year on variables were paying 1.5%. It's now 5.7%. That's more than double. It's almost triple. Okay, so that interest cost on a $700,000 mortgage is a lot of money. It's a lot of interest, and that has to come from somewhere. Okay, so be aware of what's coming. Okay, we got a few more questions here. Oh, Vince Agazzino's joined us. He's a broker up in the north end of the city. Always vacationing. That guy's got the life. I'm telling you, I need a life like that. Brazu Chianto has another, or is it Brazu Kane Tio? Are you seeing amortizations being approved longer than 30 years? No, they're not. Okay. On new business, the max is 30 years. But what's happening is on variable mortgages, we're seeing situations where trigger rates are causing amortizations to go backwards, and we're seeing ridiculous amortizations of 70, 80. I saw one for 92.5 years. Like, it's worse than a U.S. prison sentence for murder, for crying out loud. So, on new stuff, it's still 30. But on renewals, we're seeing some lenders use tools to extend amortizations to help folks out on an exception basis. Okay, if someone's in dire need of a hand to stretch amortization, certain lenders do have that tool on an exception basis to help out in a difficult situation. So that's the only place you're seeing extended amortizations beyond 30. And, you know, OSFI and the regulator, they're looking to tighten credit up. So it's not going to be loosened up anytime soon. It's going to get worse. So it's going to be an interesting year and a half, 2 years, as we start to see the effects of these rates ripple through the marketplace. But it does take time, right? There's a lag period. So just be aware of what's coming, and, you know, I'm going to do my best to help you guys through it. Realtor Joseph, 209. What's your comments on agents trying to hype the market? Okay. I'm going to be blunt. Speak to a pro. Speak to somebody who's been around. Someone who's seen the shit hit the fan in the early 90s. Now, you might be dealing with somebody with a lot of white hair. Okay? But the reality is deal with somebody who's been around, seen the cycle, seen the ugly, who could help you through this. Okay? If you're dealing with a rookie or a novice, buyer beware. That's all I have to say. Okay? There's a lot of agents hyping the market. There's a lot of agents saying, I got 23 offers on this property that's worth $1 million, but they listed it at $699. Like, at the end of the day, guys, you're either going to get fooled or you're not. So make sure you understand who you're dealing with. Deal with a pro. Deal with someone who has experience and could walk you through this and hold your hand. Okay? And someone who's going to show empathy. Like I tell first-time buyers, don't buy right now. If you have the wherewithal to buy, do not get into a bidding war. You have control. You have a trait that's not very widely held in this market. Not everybody can get qualified at these stress test rates. So wait, be patient. There's no rush, right? Like, I don't need you to buy right now so I can make money. Okay, like let's understand what the drive is. They want a sale, right? So be careful who you deal with, understand who you're dealing with, and know where they come from. Understand, ask for referrals, ask for references, and make sure you're dealing with someone who does this for a living and is not doing it part-time. Okay, because when you deal with someone that does it part-time, you're gonna get part-time results. And that's where people get into trouble. Okay, and you know, like a lot of agents refer mortgages to banks. Okay, there's a lot of road reps kicking around, pushing mortgage product, and 4 of the 5 banks have static payments. TD, CIBC, Royal, and BMO. Scotia doesn't. Okay? I hate static payments. I think they're the worst design products in the market. But realtors push people to those folks because they could get them qualified at these low rates, and the advice wasn't given to them to say, hey, if you're going to get qualified under the stress test because the variable gives you the more buying power, you should lock in as soon as you close because you have a free option to lock in. Not many people recommended that. You know, we do our best to suggest to people, hey, if that's how we're going to get in, you should consider locking in. Okay? Our office always pushed the Scotiabank mortgage. It's a true variable mortgage. Okay? Every time the Bank of Canada raises rates and prime goes up, those folks get a notice. Their payment goes up. And we always say, when your payment goes up, if you're concerned, call me and I'll give you advice on what to do. Okay? And our clients have options and they're notified. They're not stuck in these terrible static payment products that are total bullshit. Okay? And I can't tell you how many realtors told investors to get variable products. Okay? Which is the worst advice you could get. Because at the end of the day, when you have your rent that's fixed, your biggest expense, which is your mortgage payment, should be fixed as well, to limit any variation in your cash flow. And what's happening now? We're seeing a bunch of people with rental properties that have variables that are getting hammered. They're negative cash flow and they're screwed. Like, it's a shit show. So, you know, deal with a pro who's going to walk you through the process and give you good advice and give you options that you could digest, think about, and decide what's best for you and your family. Now, what I'm telling you isn't popular to realtors out there, but the reality is it's up to you to do your due diligence. It's the biggest purchase of your life. Do your homework and decide who you want to deal with. Hopefully that answers your question. Rude fella, should you lock in if you're on variable? If so, how many years? Rentals versus principal property. Well, I covered the rental issue already. If you're in a variable on a rental, that's just bad. That's a bad decision. Okay. Should you lock in now? It all depends how long you've been in that variable. If you've been in it for a year, you're going to be stuck with a 4 or 5 year term. Do you want to lock in for that long? If you've been in it for a while and you got the option to go 2 or 3, I'd look at locking into a 2 or 3 year term. But if need be, and if you lock in, do the math and see what your break-even point is. If you need help with that, give our office a call. We'll walk you through the options and we'll give you some insight on what we suggest. Stacy Nixon, Realtor. Thoughts on buying a pre-construction condo now with closings a few years away? Wise or no? I don't think we're going to see the lift in the condo market that we've seen in the past. I use this example quite a bit, and I haven't mentioned it in a couple weeks, but I'm going to use this example. There's a condo that's finished at 1 Yorkville, and it's complete, and they've got a few units for sale in the building, brand new, and they're selling for about $1,500 to $1,600 square feet. $1,500 to $1,600 a square foot. Okay. Now there's a new build that hasn't been finished yet at 18 Yorkville, not too far away, and they're selling for $2,500 a square foot. So if you're an investor or you're a buyer, why would you pay a premium to postpone a closing into the future when you could buy a completed property today at almost $1,000 a square foot cheaper? Like, think about that for a moment. Like, that's just simple math and return on investment, right? If I could buy today and take out my mortgage today and pay $1,500, $1,600 square foot as opposed to $2,500 square foot, what would be more beneficial? And this is where I think builders have built in the premium into these pre-cons because they can, right? And I think we're going to see a price correction on pre-cons, or they're not going to be built at all because the numbers just don't make sense. And I'm not sure that the 1-bedroom condo is the most beneficial down the road. The math doesn't work from an investor perspective, and I'll leave it at that. So sorry for the long-winded answer, but that's just my opinion. Doesn't mean much. Thank you, Keith, Your Mortgage Connect. Appreciate that. Midnight Jones 1969, always a regular viewer here. I always appreciate your questions. Best guess time, do you think the 5-year rate in June 2024 will be over 5% or under 5%? June 24. I'm going to say, wow. I don't know. What I do know as a guarantee in June 2024 is I will be a year older. That's the only thing I can guarantee you. But from a guess, I think it's going to hover around 5, and it might be 4.99. It could be 5.29. I'm not sure. I really, the prediction business is ugly. It's really tough, but that's a long way off, and we'll see where inflation goes and where this Canadian dollar goes, and see if this government could get some autonomy from the government, who I think has one of their hands tied behind their back. It's really tough. So we'll see. Not sure. But that's a good question. You got me stumped. The Good Life 99.9. Vince, in your opinion, how do the next 6 to 18 months look like on new builds? Ugly. Ugly. Thanks for all your invites, Vince. Johan. What do you think of the Instagram BRRR strategy in today's climate? I'm sure people that follow the strategy are biting their nails now. You got to have capital. it's really important that if you're in that strategy, if you're going to use that strategy, you got to have the wherewithal to support the costs, carry the property for a significant amount of time, and if the rates cause a problem on the cash flow side, so you have to borrow less on a property. But repurposing, I believe, has a tremendous opportunity in the city of Toronto with the as of right ability to put a basement apartment and soon to have the garden suites accompany the laneway suites as an as of right option. This could pose a tremendous opportunity for folks using this strategy, because now the repurposing of the property can add units. And it takes the whole BRRRR strategy to a different level. So I'm a big believer in a strategy. I'm involved in some projects myself, but it's very capital intensive. And if you are doing it by the skin of your teeth, like just getting by, it could be ugly. It could be a shit show if you're over leveraged. And I've had some folks call in and got burnt. They bought high, they put money in, and they owe more than what the property's worth, and they're upside down. We have a couple guys out in Brantford that are upside down about 50 grand, and they're just livid. So you got to buy right. And I think the key here is the uglier the property is and the worse shape it is, the better. But you can't always get traditional banking financing on those type of properties because they're in such tough shape. But those have the highest opportunity to improve on value. So it's a great topic, and maybe I should do a whole series on that. But thanks for the question. I appreciate that. A lot of questions today. Oh my goodness. Vince, a question. Johan, I know you can't predict the future, but like many, I've used my HELOC. Now my mortgage is about 1.89%, but it comes due in 2 years. Will my payments end up almost 2.5 times? Okay. If you have a mortgage and it's at 1.8%, pay the fucker down as quickly as you can. Hammer it down, okay? Here's your opportunity to put more towards principal than you ever can, and you'll never see 189 again. So the key is, in the next 2 years, hammer it down. If you could get that balance to a ridiculously low level, it's not going to matter what the rates are going to be at. But in most cases, you're going to see a major increase to your rate. But if you owe less, it's not going to be as much of a sting to you, okay? So, I always tell people, think of this. If you have an interest rate at 5%, okay, and you owe $200,000, your interest cost is $10,000. If you could pay that mortgage down to 100 grand and rates double to 10%, your interest cost is $10,000, right? So if you could get your balance to half of what you owe before the rates double, your interest cost is exactly the same regardless of where interest rates are, because it all has to do with the balance, okay? And this is why I always stress accelerate repayment, hammer it down, get rid of your debt, use your debt as a tool to build wealth because it's tax deductible, right? But on your owner-occupied home, the key is to get rid of debt as fast as you can and then utilize that equity, release it to access for investment purposes. But when you're owning that home that you're living in, get to zero as fast as you can, and then use that line of credit for your benefit. I hope that helps. It's tough with one income. Hammer it. Just try to do your best. A lot of questions. Wow. And we're at 4:40. That flew by. Next week, I'm probably going to have to move the show to the Wednesday, so I might do it a day earlier because I'm flying out of town for a weekend gig with my son. So I won't be available. I'm going to be out of town. I don't trust the internet connection, and I don't want to miss a show. You know me, I'm committed to giving you guys a weekly show. So I'm going to do that on Wednesday, probably same time, 4 o'clock. So I'll put some notices out there for all those folks that watch on a regular basis. I want to congratulate Mama for Two, who won the book and the $100 gift card last week. That's been mailed out. Thanks for passing on your email info and address. Folks, I asked one favor. If you can, I'm starting a YouTube channel. I'm going to try to do that more consistently. If you can, please take a moment and subscribe to Owl Mortgage on YouTube. I'd like to get a few more subscribers on there so that way I could start posting some more meaningful posts, and I'd like to start a podcast and probably invite some folks on to take part in that. But I want to thank everybody for coming in. Geez, you guys are still asking questions, but I'm going to wrap it up. But listen, thank you very much. Again, I want to stress, be kind to one another. Help somebody out. If you have an opportunity to buy somebody a coffee, a lunch, a dinner, a drink, you might be surprised that they're going to be very grateful for it. There's going to be a lot of folks in trouble. If you have the wherewithal and the means to help somebody, lend out a helping hand, because there's going to be a lot of people that are going to be struggling. And I really encourage everyone, especially on this channel, and I know that you're all great followers and you're all great people. You DM me on a regular basis. I really appreciate that for the support, the encouragement. But I just ask one thing: help one another, be kind, and have a great weekend. And we'll see you next week. Take care. Bye.